Xerfi Global has recently published a study on European power and gas utilities, which have been in for a rough ride of late due to major changes in the industry. A number of factors have been transforming the energy landscape. Perhaps most importantly, the political push for renewable forms of energy in Europe has led to a considerable change in the electricity generation mix. In 2015, over 1/3 of electricity produced in the EU was from renewable sources, ahead of nuclear, which generates 25%, coal, which generates 22%, and gas, which generates 10%. This large share of renewables is the result of huge expansion of late. Indeed, from 2000 to 2014, wind, solar, and hydro, admittedly as well as gas, have seen major net capacity expansion, while nuclear, coal, and oil have seen a drop in overall capacity. However, while overall capacity has grown, European electricity consumption has been dropping by an average of 1.2% per year over the last 5 years, and this trend is expected to continue in the midterm due to slow economic growth, but also increased energy efficiency and a shift away from energy-intensive industry. Thus, growth in electricity production capacity due to the development of renewables, combined with the drop of demand, has led to a surplus of energy and consequently a drop in electricity spot prices, pulling down utilities sales and margins. For utilities with a low share of renewable energy generation, this problem is exacerbated by the fact that the expansion of renewable energy puts pressure on conventional power station margins and their utilization, as renewables are not only subsidized but are often given priority on the grid. The market has been further shaken up by a glut of cheap coal coming onto the world market from the US, whose large-scale shale gas production means it has turned away from coal. Asia had previously absorbed a major part of these exports, but its slowdown has led to exports being funneled into Europe. Low coal prices combined with low CO2 emission allowance prices in the EU emission trading scheme due to a market surplus have brought about a change in the profitability ratio between coal and gas-fired power generation. This means that many large-scale conventional gas-based production plants are no longer competitive and are being closed or mothballed. As if this was not enough, unbundling requirements enforced by legislation have reduced synergies previously obtained via a presence along the value chain, further pulling down profits. As a result of these numerous factors, profitability of major players in the power and gas industry is in a bad way, plummeting over the last 5 years, decreasing by 12.4% per annum from 2010 to 2014 to amount to 6.1%. The evolving marketplace is pushing companies to adjust to lower profitability expectations in core European markets. Utilities are therefore adopting strict cost-cutting and financial discipline, curbing capital investment and divesting loss-generating or low-margin businesses as part of portfolio fine-tuning. At the same time, they are getting on the renewables bandwagon as well as seeking development outside Europe. Additionally, in their hunt for margin growth, power and gas utilities are widening their range of products and services to tap into new trends such as smart grids, and are entering or strengthening their position in the end customer market to cater to e-mobility and prosumer needs.